Hello friends, I am Parmananda sir, Assistant Professor, Department of Commerce, Government Postgrad College, Haryana. Today I am going to discuss with you very important topic in financial markets and institutions, that is financial intermediaries. In that we need to see role and classification of financial intermediaries and development financial institutions, that is DFIs. So let us start with financial intermediaries. A financial intermediary is an entity that acts as a middleman between two parties in a financial transaction, such as commercial banks, investment banks, mutual funds, or pension funds, etc. It means that a financial intermediary is just like a middleman between the two parties in a financial transaction. Financial intermediaries offer a number of benefits to the average consumers, including safety, liquidity, and economies of scale involved in banking and asset management. Although in certain areas, such as investing, advances in technology threaten to eliminate the financial intermediary, disintermediation is much less of threat in other areas of finance, including banking and insurance. Financial intermediaries serve as a middleman for financial transactions, generally between banks or funds. These intermediaries help to create efficient market and lower the cost of doing business. Intermediaries can provide leasing or factoring services, but do not accept the deposits from the public. So here intermediaries can provide the leasing or factor services, but do not accept the deposits from the public. Financial intermediaries offer the benefit of pooling risk, reducing the cost, and providing economies of scale, among others. So here financial intermediaries just act as a pooling agent, which normally brings all the money from the different small savers, and almost it financial intermediaries reduces the cost and provide economies of scale. So whatever advantages are there because of big scale, so that advantages will made available to everyone because of financial intermediaries. These are the roles of financial intermediaries. They provide liquidity. Almost financial intermediaries like banking institutions or insurance or pension fund, these all financial intermediaries provide cash in hand. It means that the liquidity of cash, those financial intermediaries will be provided. They provide the short-term as well as long-term financial needs of borrowers. We know very well business organizations requires capital, so that capital will be provided by these financial intermediaries. Maybe it is for short-term or it is maybe for long-term. They counsel the borrowers. Almost counseling services will be offered to the borrowers, and they counsel the borrowers. They play important role in setting up of new units. While setting or while startup a company or businessman requires a huge amount of money, so that money will be provided by the financial intermediaries. They provide infrastructural facilities. Almost financial intermediaries on behalf of the business organization, they provide the infrastructural facilities. They provide finance for development of industrial estates. Industrial estates are some areas, some locations where the industrials are located at a single place. That place is called industrial estate. That industrial estate development will be done with the help of financial intermediaries. They provide industrial sheds with all facilities where different industries work together. Financial intermediaries. They undertake promotional activities on behalf of the company or business. They take the promotional activities. They help in the generation of employment opportunities. Of course, all financial intermediaries are providing huge employment opportunities to the youth. They mobilize the savings and channelize them to productive investment. Normal savers or small savers, they can save their money, then that money will be channelized them to productive investment through the help of financial intermediaries. Then we will see classification of financial intermediaries. First one is insurance companies. We know financial institution that provides a range of insurance policies to protect the individuals and businesses against the risk of financial losses in return for regular payments of premiums. That is called insurance company. An insurance company operates by pooling risk among a large number of policyholders. From its past claims record, the company actually can ascertain the probability of a particular event occurring, for example, fire, and can assess the average financial loss associated with each event. Using this information, he attempts to calculate appropriate premiums for policyholders and from the collective pool of premium income to meet outstanding financial claims. So, insurance companies are providing risk bearing services to the individuals as well as business organizations. Next is mutual fund companies. A mutual fund is a company that pools money from many investors and invests the money in securities such as stocks, bonds, and short term debt. The combined holdings of the mutual fund are known as its portfolio. Investors buy shares in mutual funds. Each share represents investors' part of ownership in the fund and the income it generates. So these are the mutual fund companies. Then we will move to very important one, non-banking finance companies, that is called as NBFCs. Non-banking finance companies, also known as non-bank financial institutions. These are the financial institutions that offer various banking services but do not have banking license. Generally, these institutions are not allowed to take traditional demand deposits, readily available funds such as those in checking or savings account from the public. This limitation keeps them outside the scope of conventional oversight from the federal and state financial regulators. So, non banking finance companies are very important financial institutions. Next, investment bankers. A specialist in stock, bond, forex, or other markets who conducts investment transactions on behalf of the client. In addition to being an intermediary in trades, investment brokers may offer advice to clients regarding investment decisions. Investment brokers are typically paid on a commission basis. They also charge various service fees and collect interest on amounts borrowed by investors against the brokerage account. So, investment brokers just like an agents or middlemen. Next, we will move to investment bankers. An investment banker is an individual who often works as a part of the financial institution and is primarily concerned with raising capital for corporations, governments, and other entities. So, investment banker is an individual who often works as a part of the financial institution. Then, escrow companies. An escrow company, with the help of an escrow agent, provides an important service during the home buying and selling process. As the home buyer and seller sign contracts and negotiate details, the escrow company holds all pending documents and money between the two groups. The agent working for company is often an attorney but does not have to be under all state laws. The agent maintains a fiduciary responsibility to all parties involved in the transaction. This is about escrow account. Then we will move to pension funds institutions. Pension funds are investment pools that pay for workers' retirements. Funds are paid for by either employees, employers, or both. Corporations and all levels of government provide pensions. Companies reduce pension fund risk by relying on fixed income strategies. The real return for pension funds are often lower than projections. Corporations try to balance pension cost with the staying competitive. The last very important financial intermediary is collective investment scheme. A collective investment scheme is any scheme or arrangement which satisfies the conditions referred to in subsection 2 of the section 11 AA of the SEBI Act. Any scheme or arrangement made or offered by any company under which the contributions or payments made by the investors are pooled and utilized with the view to receive profits or income or produces or property and is managed on behalf of the investors is called CIS, that is collective investment scheme. Investors do not have day-to-day control over the management and operation of such scheme, that is arrangement. So here collective investment scheme is a pooling, means different schemes are pooled here, means combined here. So that facility will be provided by the collective. Now we will move to development financial institutions, that is DFIs. So here first we will see what is the history or development of DFIs. Development of financial institutions were established with the government support for underwriting their losses as also the commitment for making available low cost resources for lending at a lower rate of interest than that demanded by the market for risky projects. For the purpose of risky projects, development financial institutions helps more. In the initial years of development, it worked well. Process of infrastructure building and industrialization got accelerated. The financial system was improved considerably as per the needs of the projects. Appraisal system of long-term projects had also been strengthened due to improvement in the availability of information and skills. DFIs improved their appetite for risk associated with such projects. The intermediaries like banks and bond markets became sophisticated in risk management techniques and wanted to piece of the pie in the long-term project financing. These intermediaries also had certain distinct advantage over the traditional DFIs such as low cost of funds and the benefits of diversification of loans portfolios. The government support to DFI was also declining due to fiscal reasons or building the market more competitive and efficient. Fiscal imperatives and market dynamics have forced the government to undertake reappraisal of its policies and strategy with the regard to role of DFIs in the Indian financial system. However, it is important to note that our country has not achieved its development goals even then due to unavoidable circumstances like economic reforms. We have started the restructuring process of DFIs after 1991. Then we will move to role of development. It is supposed to identify the gaps in efficiency of institutions and markets and act as a gap pillar. It makes up the failure of financial markets and institutions to provide certain kinds of finance to economic agents who are really interested to improve the working of economy. It targets at economic activities or agents which are rationed out of market. It motivates the agent to take risky business with venture finance. It helps the fund seekers by providing concessional funds at lower rate of return. Then social return of DFIs is quite high. Keeping these facts in mind, central banking system also supports development of financial institutions. It is specialized in nature and involved long-term finance. It is exclusively meant for infrastructure and industry, finance for agriculture and small and medium enterprises, that is SME development, and financial products for certain sections of the people who needs funds for development of perspectives. Then we will see the forms and types of DFIs in India. Term lending institutions are there like IFCI, IDBI, IDFC, IIBI, etc. These extend the long-term finance to the different industrial sectors. Then refinancing institutions are there like NABARD, SIDB, NHB. These are extending refinance to banking as well as non-banking intermediaries for finance to agriculture, SSIs and housing sectors. Then third category is sector or specific or specialized institutions which are in particular sector. Those are the specialized institutions like Exim Bank, TFCI, REC Limited, Huduco, IRDA, PFC, IRFC, etc. Then last investment institutions are there like LIC, UTI, GIC, IFCI, Venture Capital Funds, ICICI, Venture Funds Management Company. State and regional level institutions are distinct group of and comprises various SFCs, SIDCs and any DFIs in the investment institutions. Then if we see the functions of DFIs, first one is improving rates of savings and investment. Of course, all development financial institutions improve the rates of savings and investment. Infancy stage of capital market, almost capital market where a capital is very essential element, so that will be provided by the DFIs. Risk averse commercial bank. Next, arrangement of loan in foreign currency, specialized credit support system, arrangement of priority sector financing. Next, project evaluation and funding, coordinating financing agencies. Then if we see some challenges before DFIs, problems in mobilization of resources, this is the major problem. Then problem of competitive interest rates are increasing, that is also very important problem. Removal of concessional rate regime, government automatically removes the concessional rate. Flexible mode of fund generation, this is also major challenge. Competitive environment, another challenge. Adverse liquidity position, stringent prudential norms are very stringent. Discriminatory government support system, the government discriminate the banking and DFIs. So these are the different challenges of DFIs. Then these are my references. Dr. G.B. Padegar, Indian Financial Systems. Bharti V. Patak, the Indian Financial Systems, Markets, Institutions and Services. M.O.I. Khan, Indian Financial Systems. Bhole and Jitendra Mahakur, Financial Institutions and Markets. T. Siddhaya, Financial Services. So, thank you for listening. Thank you, Vanatu.